Thank you, President Vern. Being a board member, we're so excited about having 15 new members coming on board in this group, and we're accomplishing two things by that. One, we're getting new numbers, and number two, we're lowering the age level of this group. So that's very important to us. My pleasure today to introduce our speaker, Eric Higgins. He served as the head of the K-State Department of Finance since August of 2008. He is an award-winning teacher. He's taught a variety of finance courses in both the undergraduate and graduate level. His honors include K-State Commerce Bank Outstanding Undergraduate Teaching Award and the College of Business Administration's Ralph Wright's Outstanding Teachers Award. The college graduate students also named him the Professor of the Semester in 2003. His areas of research include financial institutions and market efficiency. His work has been published in several journals, including the Journal of Banking and Finance, the Business Finance Accounting. In addition, his research has been presented to prestigious bank structure conferences hosted by the Federal Reserve Bank of Chicago and other conferences hosted by the FDIC and the Federal Reserve of Philadelphia. His research has been quoted in the Wall Street Journal, the American Banker, and the CNBC. Prior to him joining K-State in 2001, Eric served on the finance faculty at Drexel University in Philadelphia. He received his doctorate in finance from Florida State University in 1996 and graduate magna cum laude with a bachelor's in finance from Kansas State University in 1992. He is also a Gates Capital Management faculty fellow. He is married and has 3 children, all in high school. I think you're at Manhattan High School. Good. Dylan, Tyler, and Hannah. And wife Kathleen, he says, keeps them all under control. Ladies and gentlemen and fellow Rotarians, my pleasure to introduce you, Eric Higgins.
Thank you all for having me, and Dale, thank you for the kind introduction. I appreciate the opportunity to be here. It's always fun to kind of talk a little bit about where the market has been and what's going on. I see a fellow associate dean up here, so I can't help. So I have now transitioned to being an associate dean. So what that means is that again, I did all this stuff, FDIC. I've met 2 Federal Reserve chairmen and everything. The other day, I was worried about how many vacuums we have in the college business. That was a big deal, and it made it up to my level that we had to talk about how many vacuums we had in the college business. So that's what I'm doing now. So, but again, I appreciate the opportunity to actually come and kind of do some finance stuff once in a while and not worry about vacuums. So. Just kind of a summary of the markets for this last year. It was a pretty good year, and I always like to put a plug in for our students, the Von Wadden Student Investment Portfolio. We got our students picking stocks, and you can see we beat the S&P 500, which is our benchmark, and we've done that pretty much since 2002 when we started the fund. So students are doing a good job, but markets are up quite a bit. Oil, I think last time I was here was down quite a bit. It's back up. From year over year, went from about $36 a barrel up to about $53 a barrel currently. So we've seen some increase in energy prices. We'll talk a little bit about what that means here in a little bit. Interest rates have climbed slightly, but not a lot, even though we've had some interest rate increases, and we'll talk about some implications of that. But overall, in terms of markets, it was a pretty good year, and the economy seems to be doing pretty well. So what were the big headlines from 2016? Well, the first one, I think, economically speaking, would be Brexit. So many of you are aware of what that is. The UK voted to leave the European Union. And so what does that mean for the EU and the world economy? And I think it's a good question to ask. And so what you see up here is a little graphic that shows you both current and expected GDP for the UK, depending on different scenarios. If the UK were to be more isolationist, if they were to kind of reverse the Brexit policy and so forth, what you can see, and it's a little bit like most developed countries right now, GDP growth is not very big. So even in the best case scenario, it's probably 1-2% for the UK. Kind of the same way as the United States. The larger developed economies have kind of slowed their growth. Obviously, that's something that the president ran on, is, hey, I'm going to get 4% GDP growth, and I don't know, we'll see. But developed nations, we're just not seeing very rapid growth. Now, obviously, in the UK, depending on what happens, we could see a significant slowdown in their growth if there were, to kind of move towards a more isolationist stance and kind of ignore the EU. Given what's going on, I would say that's probably not likely to happen. I think there'll probably still be pretty open markets, but it does beg the question. There are many U.S. companies, financial companies, all sorts of multinationals that are headquartered in London, really, that may need to move if they decide to get out of the EU, and there's implications of that just to be more near the financial hubs of where the activity would be. Globally, it's probably not going to matter a whole lot because their economy is just not that big, honestly. So I don't think globally it'd be that big a deal. There's concern about what might happen in the long run to the EU and the euro, and that very well could be a concern going forward. What happens with that? I don't see it going anywhere anytime real soon, but it's possible that the EU could break up and kind of go back to the way it was. That would probably have more of a market impact than just the UK leaving. But again, that probably is not going to happen anytime soon. What is kind of interesting is that talking about oil and gas. At one time, when we weren't doing so well after the economic crisis in 2008 and 9, everybody was talking about, well, we're going to denominate oil in the euro because it's a much more stable currency, and da-da-da-da-da. Not happening, right? So we kind of won that deal. But so oil still dominated in dollars. So we'll talk about that. Next big headline was the Trump bump in the market. So a lot of the gains that you saw in the market really kind of occurred in the last couple months. So if you look at, this is from the election day, the Dow's been up, this is to date, so not the other was year end, but Dow's up 12, S&P up about 9, 10, NASDAQ up 12. So, the market responded real positively. Went over 20,000, the Dow did for the first time, and so we're seeing a nice rally in that. We'll talk about that and whether that can continue or not. We'll see, but we'll talk some about that. But obviously that was a big headline. Most pundits expected the opposite. Didn't happen. Actually went up, and so I'm pretty happy because I'm sure a lot of you are. You probably made some money, so that's a pretty good deal. Another big headline that happened towards the end of the year was the Federal Reserve again. So for the first time in a year, last time they did this was in December 2015, and that was raise interest rates. So they raised interest rates another quarter point, bringing the Fed funds rate up to a whopping 0.5 to 0.75%. So still not really high, but we did see, if you look back, those interest rates now, the 10-year Treasury, starting to creep up slightly, but still at historic lows. Mortgage rates, historic lows. Interest rates, money is still very, very cheap in today's economy. So, no real worries with that in terms of inflation or other things. The one concern, and it's one that, I think I've been talking about this since, look at that graph, 2012, and that's the size of the Federal Reserve balance sheet. As you can see that graph there, the Federal Reserve balance sheet is at $4 trillion. That balance sheet is bigger than most economies in the world. If you want to put that, like Germany, it would be close to their total output. So the Federal Reserve continues. You see that that the line is not going down. Okay, so interest rates are going up, that obviously is, trying to tighten monetary policy, but the amount of money that the Federal Reserve still has out in the economy is massive. And most of that money is held in treasuries and mortgage-backed securities that they bought from Fannie Mae and Freddie Mac. And continue, what they're doing now is, and the reason it hasn't changed, is they're reinvesting. So they're not changing the level. They're not adding, they're not subtracting. They just take the money as they expire, they roll it in to more treasuries, more mortgage-backed securities. So you still have a massive, massive amount of currency that's in the marketplace thanks to the Federal Reserve, and in my opinion too, a mass amount of support for the real estate market. And so if you've noticed, home prices have really shot back up to levels that existed pre-crisis, outside of a few isolated areas. To me that's somewhat concerning. We've kind of created another bubble, I think, in real estate throughout the United States due to kind of propping that up by the Federal Reserve. Now, if you look at the mandate of the Federal Reserve, nowhere does it say prop up the real estate market. But I would argue that that's exactly what they've been doing for, since really 2012 and 2013. And so, I think that it bears watching, see what happens in the real estate market. But, again, Janet Yellen, when in December, was talking about this, said, well, we still have some tools available to us. We could cut rates. Well, come on. I mean, so you could cut rates, 50 basis points, but what are you going to do? You going to buy another $4 trillion worth of bonds to pump money in the economy? I don't know that we have a lot of degrees of freedom when it comes to thinking about monetary policy. So until we start to unwind some of this balance sheet, I think let's just hope the economy stays good. It's kind of the way we've got to proceed. Fortunately, it has been. So if you look at some of the key indicators that the Fed would look at, for example, these are the things they look at: unemployment, GDP growth, and inflation. Unemployment is down to 4.8%. That's as of January. That's what a lot of economists would call full employment. If you're unemployed, it wouldn't be, but that's what economists consider full employment. So they feel pretty good about where they're at with that. Inflation, I'll come back to GDP, relatively low, although if you look at, this is January year over year, most recent data that we have. Inflation year over year in January was 2.5% annualized versus 1.5% last year. Reason for that is gas prices were up quite a bit, kind of drove up inflation. If you've been around Manhattan, they've kind of come back down, and that's happened across the country. And so likely you'll see that inflation will kind of go down a little bit over the next several months. But even at that 2.5%, that's really low. They want to see about that 2.5% inflation. Actually, inflation's probably been too low, and this is something you've heard me talk about before. One of the things that we're still not seeing a lot of growth in is wages. And so what the Federal Reserve would like to see as they increase interest rates, and we see decreasing unemployment, is they'd like to see increasing wages. But we're not seeing that. We're not seeing real rapid growth in wages, and they tend to be about where GDP growth is, 1.92%, so fairly slow growth, which creates problems, right? If you got 2.5% inflation, but my wages only grow at 2%, and all of a sudden now I'm not doing so well. And that's one of the issues that we have, is that we have seen more employment, some growth. It's fairly low growth. And Janet Yellen did say, that she wasn't real excited about our 1.9% growth, and kind of, I think, chastised the federal government a little bit for the size of their balance sheet, although not her own, but the government. So, I think, again, structurally there are some issues in the economy that need to be looked at, and whether or not they get addressed or not, it kind of remains to be seen. So, the last thing I'd leave you with is a strong dollar. Okay, so if you take, here's a graphic of that. We've seen a very strong dollar in the last couple of years, pretty big run-up. Really kind of the strongest, I could go back, probably the strongest dollar we've seen in maybe 20, 30 years. And if you think about that with interest rates and other things, the U.S. is a safe haven for investors. People want dollars, people are investing in treasuries. And that is continuing. So while our economy is kind of the analogy I always use, it's being the valedictorian of summer school, okay? It's not a great honor, but it's an honor nonetheless. Dr. Shannon. So anyway, but that's kind of where we're at. We're kind of plodding along, doing our thing, but what's happening is everybody wants to be here. Money wants to be here, which is great. Money wants to be here. We got low interest rates. We got more purchasing power. We got all sorts of good stuff. I don't see that changing, no matter what happens. We're still probably the safe haven for money. And as long as that's the case, we'll probably do okay. So, but that's just kind of indicates that. So what are we looking for? Well, everybody wants to know what's going to happen with Trump. Now, we've seen the Trump bump. I would suggest to you that a lot of that bump probably is occurring because of what people expect to happen with taxes. Okay? Most people assume that Trump will eventually lower the corporate tax rate. If the corporate tax rate gets lowered, businesses make more money, stock prices go up. So I'd say that Trump bump is probably a reflection of expectations about future changes to tax rates. So a lot of that's probably priced in already, so don't get real excited about tax cut, because the market's kind of moved that way. They expect those sorts of things. If anything, the longer it takes for that to happen, the more the market's likely to go down. So I think you've got a fair amount of that priced in already into the market, and that's what you've seen, and that's what's driven that bump. So I don't think it's in any way response to who won or not, just simple policy. You lower taxes, profits go up, stock prices go up. It's flat out what it is. And so that's what everyone expects. If it doesn't happen, market's going to go down. What's going to happen. So I think that's what we're seeing there. I don't know what they will do. I have no idea. So they may do that sometime soon. One that has gotten a lot of hype, but again, nobody ever wants to pay attention to the past. One thing, and C. Clyde would tell you, is we need to teach some economic history once in a while. I'm big on that. And so, repatriation of foreign earnings. Anybody heard of that one? It's like, all these companies have $11 trillion overseas, and by golly, we're going to get it back, and all that stuff, right? Everybody's all fired up about it. Okay? All right. There is. There's a lot of money over there. Why do companies do it? So they don't have to pay taxes. So they make more money. So stock prices go up. So everybody's 401k, we're benefiting from the fact that these guys are hiding money and not paying taxes on it. That's cool. All right? They make money. It's great. Now, if I all of a sudden say, well, I'm going to lower the tax rate for foreign companies on these foreign earnings, and we're going to bring it all back into the U.S., and it's going to create all sorts of investment. Well, guess what? We did that before. We did it in 2004. It was a tax holiday where we tried that. And can you imagine what happened? Nothing. Nothing happened. The reason nothing happened was so these companies were supposed to be able to bring this money back if they didn't pay it out as dividends, if they didn't use it to buy back stock, if they didn't use it to raise their salaries, but invest. Okay, well, what did companies do? They brought the money back and said, well, I'm investing it here, but all the money I was investing, not paying out as a dividend, buying back stock. Because money's money, right? Money's fungible. How's the government going to know what money you're spending? You got $2 bills. Which one did I spend? I don't know. Doesn't matter, right? And so it worked not at all to do what they wanted. And this is something that has been researched heavily since then. So there's tons of academic research and other research that has looked into this. It's not a political thing. It's just is. That's what happened, And so, it'd be interesting to see what happens. My guess is if they do it, a lot of money will flow back in, and if you own some of these stocks, probably get a good dividend. Congratulations. So that's likely to happen. So that one, don't think that's a real big deal. Some of you in the room, I can look around and see you've probably been impacted by the fiduciary rule. And that's been in the news in the last couple weeks. President Trump has kind of, I'm buzzing to tell me I'm almost done, has put into place some slowing down of the fiduciary rule. Fiduciary rule affected investment advisors that were dealing with retirement accounts, rollover IRAs, those sorts of things. Meant to increase disclosure, some other things of that, trying to reduce fees and so forth. I think the rule itself stinks the way it's written. It's poorly worded, poorly written, poorly executed. However, I think if you start rolling it back now, you're going to create more confusion. Because I guarantee you, if you're an investment advisor, you've probably been talking to your clients about this for the last 6 months. Getting them ready. Here's what's going to happen. You're going to have to fill out all this stuff. You're going to have to do this. You're going to have to do that. Now you get to go back to them and go, remember all that stuff I told you about? Forget it. Don't worry about it. Come on. I think, maybe some common sense on how to implement it, on how to maybe tweak the rule to get at what we want is we want investment advisors to be honest with their clients, and most of them are. Some of them aren't. Most of them aren't. We want them to be honest, and we want them to disclose fees. That's what we want, okay? Let's see if we can't focus on that as opposed to repealing it or mountains and mountains of paperwork that's completely useless. On a side note to that, since Earl's here, former president of the American Bankers Association, way smarter guy than I am about this, but what's going to happen with Dodd-Frank? I didn't put a bullet up there, but what's going to happen with Dodd-Frank? Well, the Treasury Secretary that's just been confirmed, Steve Mnuchin, is a Goldman Sachs guy. He's probably not going to care one iota about small banks here in the state of Kansas, which are probably the entities, small banks all around the country, that have been most impacted by Dodd-Frank, by excessive regulation by the Consumer Financial Protection Bureau, my least favorite agency in the whole wide world. We should get rid of it today. That is killing our economy. It's killing our economy because how does growth happen? Growth happens because bankers make loans to small businesses getting started that end up growing into Apple and Google and everything else. Right? We don't grow by helping J.P. Morgan make more money trading currencies, which is what's going to happen under the current Treasury Secretary. Their focus, you can just see it, their focus is going to be on large banks and rolling back Dodd-Frank for them. I hope that they get down to thinking about some of the other regulations that have been put into place that are killing banks throughout the state of Kansas and across the country. But the reality is, I don't know. I don't believe it'll happen because you can just look who they put in. Okay, so that's one thing I would say that, hey, if you want to roll back some regulations, I got a list. Okay, and it doesn't start with worrying about J.P. Morgan trading currencies or whatever they're doing. Okay, so anyway, get off that soapbox, but I think that's important to look at and think about. The last one I'll leave you with, running out of time, but is China. So I think as we look at 2017, we need to look at what is happening in the Chinese economy. Because they're a giant economy. They're a huge part of the world. And we seem to want to be picking a fight, which, fine, I don't care about that one way or the other. But understand that economically, China's probably got some pressure on them right now. Okay? So if you look at their equity markets, you can kind of see that there. They had a big run-up in 2014, 2015, come crashing down. It's pretty flat. A lot of people in China lost a lot of money. So they got a lot of financial pressures. We've seen it at K-State. Enrollment of international students from China gone down to almost nothing. Why? They don't have any money. All right? That's the way it is. Another reason they don't have any money is that their government has made it worthless because they're devaluing their currency. Why would they devalue their currency? Spur exports, try to grow the economy because they're struggling. They know it. Now they manage their currency, we don't. So they're devaluing their currency. What does that do to real estate in China? Skyrockets real estate prices. So you got the folks who probably lost a whole bunch of money now paying a lot more for houses. They can't buy as much stuff. Structurally, real bad for the economy, right, when you think about it. And so you see their GDP, they used to be the powerhouse. Well, that's kind of leveled off a little bit in the last several years. And so, you know, I always worry about picking a fight with somebody who's backed into a corner. And economically, they're a little bit backed into a corner because there's not a lot of room for them to do much. And so have to be a little careful about that. So, you know, again, I think it bears watching, both economically, from an economic standpoint, that obviously a huge driver of the world economy, but also from a political standpoint. This economics will play into the political decisions, I believe, that the Chinese government will make coming down, you know, down the pike here. And so I think we have to be conscious of that and understand where they sit economically so we don't put them in a position that becomes unacceptable. So, because they also are, I think, probably one of the largest militaries in the world too. And we have to be careful of what we do. So anyway, I think that one bears watching in 2017. Kansas, we got work to do. We'll just leave it at that. But you know that's kind of the way that is. So we can talk about that some other time. So I think I'll have maybe a minute or two, Vern, for questions. If you've got any questions, I'm happy to answer. Yeah.
I understand the new president has concerns about NAFTA and whatever
Right.
that Asian trade agreement.
Right.
What should we make of trade agreements in Washington?
Well, you know, again, probably as the economist in me says, you know, I like free trade, but at the same time, I don't disagree. I don't see why we have to give it away if nobody else is going to play by the same rules. That's one of the things that always kind of irks me is that take drugs, for example. You know, drug companies have been in the news. I could have put that up there, all raising prices and that. Well, why are drugs so expensive? Because everybody around the world rips us off. It's the way it is. And so if we want R&D and technology and developing things that are make us healthier, well, the only place the companies can make money is here because everybody else steals it. So, you know, again, I kind of, there's got to be a balance somewhere, right, with that. In that, you know, if countries aren't holding up their end of the bargain, then fine. We're going to walk. And I think that's kind of what they're saying. I don't think they want to engage in trade wars, and especially with China. If I were focusing on that, I would focus on intellectual property protection as a cornerstone of any trade agreement that I would do with China. And some of that was in the Trans-Pacific Partnership, but I don't think it was strong enough. So that would be my take on that. Yeah.
Eric, thank you. You've indicated a distaste for such things as regulation and consumer financial protection.
Yes.
I wondered what you would regard as optimal levels or optimal types of regulation or consumer protection.
I think we had it. I think what we've seen is consumer protection is great. The Consumer Financial Protection Bureau, which was created out of Dodd-Frank, is awful. They created a bunch of redundant regulations that were already in place that served no purpose other than to increase costs and create a false sense of security as well as complexity. So we have to have consumer protection. 100% agree with that. The Consumer Financial Protection Bureau is useless. So that's a difference than that. So we had and still do very strong consumer protection laws. They just need to be enforced. We don't need to double them.
Okay, time for one more question.
Yeah.
What point does the size of national debt drive the interest rate decision?
Well, you know, obviously Janet Yellen's got concern about that, but she can't control that. And so I don't believe that the Federal Reserve looks at that in terms of ultimately making interest rate decisions. I think it's a factor, but I think in terms of it being a driving factor, it's not. I think what they say is, look, if you keep doing this, you're going to create problems, and then we're going to have to do something to try to get stimulus going again. this goes back to what I'm saying, we don't have a lot of degrees of freedom on stimulus. So we kind of have to be careful about how much debt we have. But they don't concern, Federal Reserve does not at all concern themselves with the fiscal side of the house. You know, they'll comment, but I really, other than reacting to what happens, I don't think they do much other than that. Good question. Yeah. Okay, great. Thank you, everybody.